I think we should talk about first the risk, or if we can explain what sequence of returns is, because sequence of returns risk is a very major risk if you're getting ready to retire. And if you retired in 2000, people don't remember the market was down in 2000, 2001, and 2002. We all know what happened in between all that. It was a lot of chaos in those times as well. That's 3 years of negative markets. So if you can explain sequence of returns risk, what that means.
So one of the things that we use for the families we work with, or a prospective client comes in, we use this software called Riskalyze. So Riskalyze, what it allows us to do, it allows us to quantify a portfolio and how much risk somebody has in that portfolio. So we look at risk on a scale of 1 to 100. Think about it almost as like a speed limit sign. 1 is cash, risk-free. You're kind of going 1 mile an hour in the slow lane. You got people in Boston honking at you, telling you to go faster. And then you've got the other side of the spectrum, which is 100. 100 is your Tesla stock, Bitcoin, NVIDIA. It's the companies that everybody wants to be invested in the 23s and the 24s when they're up 100%, right? But the reality is we just don't see that every year. So one of the first things we look at when people come in is we want to quantify where their portfolio's at. A lot of times somebody will say, oh, I'm conservative, or oh, I'm moderate. But what exactly does that mean? That kind of means something different to everybody. Yeah. So I think a good example for that in terms of sequence of returns, somebody my age or Derek's age, we're a little bit on the younger side. We probably have a number of years to go until retirement. It doesn't necessarily matter what happens to us this year, next year, even the year after. If the market sells off 30, 40, 50%,
it's actually better.
It is better, right? Like we're not overly concerned. We're buying more. It's actually helping us in the long run. However, somebody that's retired or they're heading to retirement in the next couple of years, that's probably not going to make you feel pretty comfortable, I'd say. So let's just use the example of somebody that has $1 million portfolio. You're collecting about $5,000 a month in Social Security and pension income. So you need $50,000, and we're not really looking at taxes in this conversation at all. So let's say we saw 2022 happen, right? Stock market was down 20, 25, 30% if you were invested in the NASDAQ. Aggregate bond index was down, about 15% that year? So that was kind of an anomaly in the market. So that $1 million portfolio, even if you were invested in like a 60-40 portfolio or even a 50-50, you could have been down 20%, right? So your $1 million is now worth $800,000.
Minus the 50 you took out.
Which brings you to $750,000. So now we enter 2023, which was obviously a good year in the market, but let's say we didn't see a good year in the market.
Yeah.
Let's say we had another bear year or another downturn in the market. Well, 2023 comes around, you're still taking those vacations with your family.
Yep.
You're still gifting to the kids and the grandkids. What do you need that year?
Same thing.
You still need that 50,000, right? So that 750 now comes down to 700,000. How does that shape the long-term longevity of your portfolio?
And that's only 1 year of loss. Let's say the second year is down the same. Now you're down to 500,000. So you're 2 years into retirement. Your money's cut in half. They're not going to keep the investments like they are. No. You work your entire life, and you happen to retire during a bad market, and the sequence of returns during your first couple of years is negative, and your portfolio is cut in half in 2 years, and that's devastating.